Welcome to Investing. This is the first in a progression of instructive and educational videos concerning investing and doing it properly. These lessons will blanket all parts of the investing world and giving you strategic systems to fulfill your goals. This first piece is designed for the relative newbie, however, even veteran investors will probably discover many things of worth in it, so pay attention. We hear many people speak of the market, but if you ask these same individuals what the market is, few can actually define it. In layman's terms, the market is each and every option that is open to you to invest in, with the objective of making money so that you can turn around and use that money for other things you want. For example, retirement, college fund, that sports car, whatever. Some folks' investment methods are in obtaining securities, and as we might see, this has its points of interest. For others, it's more lucrative yet riskier investments. For some, it's backing in bonds, and still others can best be suited by putting money into commodities. Each and every one of these conveys its particular level of risk and payoff, and is totally dependent upon you to equalize those two. Past that, there's sinking money into land or art. I leave the field to these previously mentioned individuals who actually accept they'll retire comfortably after sinking money into sports memorabilia and vintage collector's items and baseball cards and comics. It's not something that I myself am thoroughly knowledgeable in. It's too simple to state that your objection is, quote, profiting. Everyone runs into investing with the resolution of profiting. The vast majority of these folks will lose some or all of what they contribute because their goal is just so vague. I can easily say that I see 90% of folks who begin investing with merely this aim of profiting. I see them leave it as washouts. It's just then an issue of what they pick to lose. The object of these videos is to get you into that bracket of under 10%ers. These under 10%ers end up as winners. In this way, what are the contrasts between the few champs and the numerous flops? Perhaps the most outstanding distinction is self-control or self-discipline. You can consistently spot the beginner, or the undisciplined card player at any poker table. That individual is constantly playing hands. Assuming that you're looking to end up winning at the close, you're hard at work to getting your pockets stripped by playing excessively, hand after hand after hand. This is presumably the greatest misstep that new investors make. They suspect everything will turn a profit. By thinking this, they lose their investment bit by bit, and strangely, this is usually to broker's fees. All investments do have the potential to be winning chances. However, will it be the right chance for you? That's the question. You know your criteria better than me. You know it better than your brokerage agent, and without a doubt a cut above your fiscal organizer. Because of this, you do need to take an exceptional and a long and a genuine look at what you want from any given investment. The following lessons will demonstrate to you proper strategies to figure out if the potential is there and how to get what you need from each investment. This is the first test you might as well apply. It's also the first test I'll demonstrate to you. In the event that the potential investment passes this test, there's obviously more tests. If it doesn't pass the first test, throw it away. Don't look back. Do not trouble with any further tests. Regardless of how exceptional it might look, assuming that it isn't a good fit for you, you're free to move on to something else. More chances will come along. Let's compare the scenario to a city bus or a subway. There's continuously a different one coming along, and similarly, as you might be tempted to get in on the wrong bus or the wrong train car, you might like to sink your cash into the transaction that's wrong for you. Both the investment in the bus or the subway, it'll take you to some other region. The obvious object of this practice is to get you where you need to go. The second huge failure that I see plenty of investors make is also identified with self-control. The market is fueled by changes, and the crowd dictates those changes. The crowd and the market are greater than any one individual or even a group of people. Again, how the crowd behaves, it dictates how the market moves. The funny thing is that the crowd is not constantly right. Oddly, the crowd is wrong more often than not. Now, why is this, you might ask? I could thoroughly define it. I could define mass movements and illustrate how they function, but I'd rather relate this instead. The next time you see an incredible motivational speaker, just pay a little bit closer of attention than you normally do. In spite of the fact that that individual is indeed tending to a whole audience, that speaker will lock onto one individual in the audience, and he will focus on merely that person. Once you've changed over one, the rest fall effectively. Soon the entire swarm is with the speaker. Same with investments. Just get a couple folks fascinated by an investment opportunity, and soon enough a lot of people are intrigued by it. You can do this backwards. Persuade the crowd that a certain stock is worthless, and the stock's value will reflect this. It will drop. It may not appear that way, but just keep in mind, when you purchase shares of John Smith Technologies Incorporated, for example, in the expectation that the stock will go up, you're purchasing it from someone who faithfully trusts that it will go down. If you profit or lose cash doesn't matter. Each time your trade goes through a broker, a bit of your cash rubs off on it. While certain brokers are indeed fantastic individuals and their motive is honestly to help you become profitable, there are those who are solely motivated in having as much of that commission rub off on them. They're not concerned with anything else. We don't like these brokers, and we will be showing you how to avoid them. Now consider this illustration. Recently, there was a small pharmaceutical group that supposedly had a cure for HIV. Furthermore, there were some heavy-hitting investors who were hopping on this specific trend. In the blink of an eye, the group's shares went from roughly $1.50 a share to over $30 a share merely on the assumption that this small company had something that had evaded the best scientists with the most fantastic assets since the discovery of the virus itself. Now, rest assured, I'm not one to put down the conceivability of a lucky hit or even the enthusiasm, whatever the origin. I'm told that had any individual proficient in the field actually checked out what they were doing, they might have realized that this was totally a dud. To the group's credit, they made their research 100% transparent, so no person can blame them for concealing anything. But it's a case where some honed learning might have paid off by either A, getting in and knowing when to get out, or B, just staying out completely. Choice A or B is dependent upon you, and this is where I encourage you to know yourself and what you need to get from making your transactions, like I've said before. Getting in can bring about enormous and a fast influx of cash, but here's the thing I need to make crystal clear. With something like this, it didn't matter that they really had a cure for HIV. What matters is that the crowd accepted it may be correct. Had you investigated their claims and the crowd's assumptions, you might have realized that under the most favorable conditions, they were misrepresenting the viability of whatever they did have. If you think about this for a moment, you'll totally understand why it doesn't matter either way, cure or no cure, from an investor's viewpoint. If there really was a cure at this association, the stakes might not have ceased at 30. They would have probably gone through the roof. The craft is not in knowing when to get in. In fact, it truly doesn't matter at all when you get in. But what matters is knowing when to get out and finishing this viably. So how'd the story end? The folks with the privileged info bought stock early, rode the wave to the top, and sold their portions to those who knew no better. Then they sat back comfortably as the stock nosedived to flatter than it was before the hype began. Now, few things are more inspiring than buying a share at $1.50 a pop and selling it at $30 a share a week or two later. On the other side, nothing is more tormenting than buying it at what would, $32 and finding it impossible to get rid of it at under $3. The strategy is to get yourself in that first assembly of individuals, obviously, and it's to keep away from ending up in the second group. Fear not, these lessons will teach you. However, such chances are few and far between. Regardless of the possibility that you discover quite a chance, and regardless of the fact that it's sturdy, make sure that it's the right thing for you and the potential results are aligned with your objectives. The third aspect of self-restraint descends to knowing when to get out. Remember, the crowd dictates the market's movement. Regardless of the possibility that you became tied up with that group at $32 a pop, and regardless of the fact that you end up in the tragic position riding it descending, you should have the moderation to concede to yourself that you've committed an error. Everyone does it. Cut the loss. Get out now. An excessive amount of folks make the oversight of accepting that a terrible transaction will turn around, permitting them to recuperate some or the greater part of their loss. Here again, it's back to basics. If the association is a sturdy one, there's a distinct possibility that it will recuperate in time. Here is when you determine for yourself if this patience is aligned with your goals. In the event that it is, then you should have the self-control to stay with it. Provided that it is not, then you should have the restraint to get out. It is always uncomfortable admitting that you've made a mistake, even to yourself, even behind closed doors with no one watching. It harms all the more when that mistake was regarding something as critical and as private as one's money. Keep in mind one extremely imperative thing. The heaviest hitters on Wall Street, the men who turned $10,000 into $10 billion, 90% of their profit comes from 10% of their contributions. In different examples, each investor, regardless of how fruitful, has a far greater number of failures than victories. It is solely on you to cut the dead branches to maintain the successful opportunities and be freed of the failures. It all descends to keeping up moderation and keeping your eye on that objective. Without that control, having every last trace of information, every bit of qualified data, all the ability, every last trace of strategy on Earth, it would never help for the reason that you'd be incapable of applying these tools. Now, I realize I've put a ton of information out here, and I definitely don't need you to swallow it all at once. There is absolutely no disgrace in rewinding the video and viewing things over. I would recommend it and encourage it. Please, feel free to take notes. Feel free to ask questions. With the assumption that you are indeed thinking critically about these investment topics, deciding what criteria and strategies suit you and adhering to them, you'll be just fine. Now I'll summarize. Number 1, know yourself. Know what you need to get from each investment. Number 2, verify how comfortable with risk you are. This is something you and only you can know. Number 3, improve your restraint for staying far away from what is not ideal for you, and in the meantime, having the control to ride out changes in what is good for you. Number 4, be aware that you are not perfect, and sharpen the self-control needed to get out of a bad investment instantly when you do distinguish that you are on the losing close. Provided that you take these 4 standards seriously, you really study, you really apply them to your trading, this might well have just been the most valuable 15 minutes you'll ever spend. On the further lessons, you'll learn more about yourself. I look forward to seeing you.